Hello everyone. In this lesson, we'll be learning about the put-call parity. The put-call parity is a single equation. What it does is that it connects the price of a call option to a similar put option. Okay, so this is the call option price, and this is the put option price. And this equation is for European options as opposed to, for example, American ones, which we covered in previous tutorials. So remember, European option can only be exercised at the expiry, whereas American ones can be exercised anytime until the expiry. Okay. But this equation is for Europeans, call options and put options, and is for non-dividend paying stocks. Later in the video, we will look at the same equation or the version of the equation for dividend-paying stocks as well. So like I said, it links the call option price to the put option price, and the S here is the current stock price. So this is the stock that is underlying the contracts. K is the strike price. And note that we are talking about a call option and put option sharing the same strike price. And R is the risk-free interest rate. Okay, so this is the risk-free interest rate. And basically, in reality, you would proxy this by yields on treasury bills. Okay. Now, let's illustrate how this equation works with a simple example. Okay, so the current price, so we have a stock that is currently trading for 47. So this is our S. And we also have a put option on this particular stock that has a strike price or exercise price of $52. So this is our K. And the value of this put option contract is $9. Okay, so this is our P value, the price or value of the put option contract. And the risk-free interest rate is 4%. So the question asks us, what should be the price of a call option with identical features to the put option? So with the same exercise price and same expiration date. So essentially, we are trying to solve for C. And we can now use our put-call parity equation. So we have all the inputs that we need. P is 9, S is 47, K is 52, R is 4%. In fact, if you divide, so 4%, if you divide 52 by 104, I picked these figures on purpose, this would be exactly 50. So the call option price in this case should be $6 according to this parity equation. On our website, we actually have a handy online calculator, which you can easily use to double check your answers. So you can find the link in the video description. So we again enter the put option price, stock price. So in this case, the dividend is 0, but we will see the dividend paying version as well. Strike price 52, risk-free interest rate 4%. And the calculator gives us the call option price as $6. Now, let's move on to the version for a dividend-paying stock. And we simply modify the equation to add one more term. And not surprisingly, this term will relate to the dividend of the stock. And the assumption here is that basically the underlying stock will be paying a dividend around the expiry date. So that amount of dividend is D, and all the rest is exactly the same. Okay, nothing else changes. Now we can revisit our previous example, and every input is exactly the same, identical, except that now we incorporate a dividend payment of $1.04 per share. So let's see now how the price of the call option will be affected when we introduce this $1 dividend rate. So exact same equation. So the stock price is currently 47. Dividend is 104. strike price is 52, R is 4% here and here, and the put option price is still $9. Again, we can use the same calculator. So originally we had 0 dividend, but now we will basically update it as a dividend of 104. And you can see that the call option price will drop from $6 to $5. Okay, so this is the new price when there is a dividend payment of 104. Next thing I would like to discuss in this lesson is why do we expect this parity equation to hold? So what is the logic or the intuition behind it? And it's quite nice to understand that. We see the equation, but it'd be nice to know where it comes from. So the intuition goes as follows. So let's say I buy a certain stock base, some shares. So let's say 100 shares of Tesla, Amazon, Walmart, McDonald's, whatever you like. Okay. Now the payoff I get by holding the shares will depend exactly on the stock price. And for simplicity, let's say this is a non-dividend paying stock, but that's not so important, just for simplicity. So if the price goes up, I will be making profits. For example, if I buy the stock somewhere here, if it goes up, I'm making a profit. If the price goes down, I'm making a loss. And let's say I don't like the idea of making a loss. So what I could do, so far, let's say I have purchased the stock by paying S at the current price. What I could do, for example, if I don't want to experience any losses if the price goes down the current price, I could buy a put option, right? The put option basically gives you downside protection. Why? It gives you the right to sell the underlying stock at the exercise price, which is fixed by the contract. So what the put option does is that it limits your downside. So in this case, let's say this was my purchasing price. So let's say this is, $50. So I can buy an at-the-money put option, which also has an exercise price of $50. So if the price goes up above 50, that's great, right? I'm going to be basically gaining. But if the price goes down, I'm not losing because I can exercise my put option, which will be in the money in that scenario. Of course, that option is not given to me free. I need to purchase that. So in addition to buying the share of the stock for S, I will also pay for the put option, right? So my total investment is P plus S. So I pay for the put option and I pay for the stock. It just happens that I can create this payoff schedule with a different strategy. In fact, without using the stock itself. So let's see how that works. So this is an alternative strategy. So again, let's say I would like to limit my downside risk. But now, instead of actually buying the stock itself, I will buy a call option on the stock. So this is the call option payoff, right? So it is basically, again, this is the strike price. So let's say 50. So anything below 50, the stock option, the call option is not valuable because why would I pay $50 for the stock if I could buy it cheaper in the market? But if the stock price goes up beyond 50, then the call option becomes in the money, right? Because now let's say the call option the stock price is 60, so I can buy the shares for 50. So already this payoff schedule looks like this one, but it's not exactly the same, right? So I need to somehow lift this up. So far, basically, I have paid for the call option. Okay, so this is my current investment. So I bought the call option, but I need to lift everything up. And to do that, basically, I can invest in a risk-free bond that has the same value as the exercise price. So this is going to be the face value of this zero coupon bond. So the present value of the zero coupon bond is essentially, so this is my strike price, right? The present value of the bond is K discount back at the risk-free rate, right? So this is a risk-free zero coupon bond maturing exactly at the same point when the call option expires. And this K over 1 plus R is the price I need to pay today to purchase that zero coupon bond. So let's call this horizontal line my first part of my investment, and let's call this call option the second part of my investment. So if I add them up, I end up with this payoff schedule, right? So I'm simply adding up the payoffs, 1 plus 2, and I've got this red payoff schedule. And now if I compare right-hand side and left-hand side, the payoff schedules are identical, right? And in finance, if two portfolios have identical payoffs, they should trade at the same price. So how much I paid for the left-hand side portfolio? The put option price plus the stock price. How much I paid for the right-hand side portfolio? The call option price plus the price of the zero coupon bond, which is the discounted face value. So these two should be equal to each other as well. And this is exactly my equation, right? So if I solve for C here, so this will give me the put call parity. So I can write the call option as a function of the put option. So it will be P plus S, right? And if I put this term on the other side, minus K over 1 plus R. So if you check the previous parts, you will see that this is the put call parity equation that we had derived. Okay, so this is where the logic comes from. So before we finish, here is some homework for you to test your learning. And you can find the solution to this question in the video description link. Basically, it will take it to our website where we have the put call parity calculator as well. I hope you have enjoyed this lesson. So in the course, we will continue learning about options trading. And in the next lesson, we will be talking about different types of options in the sense that we have so far talked about stock options only, but option contracts can be written on other types of assets, for example, index options, right? So these are different types of options we will be talking about in the next lesson. Until then, goodbye and take care. Bye for now.